Hello, Sky. Sorry for the delay. Actually, um, having some technical issues, and Ellen has just been working on this all day. It's gotten kind of frustrated with some of the issues getting it formatted correctly. StreamYard doing the live premiere, and YouTube aren't cooperating. So she's taking a little break. Still trying to get it uploaded to YouTube. It's the process. Do not know whether this attempt will fail or not, but kind of have a workaround. Appreciate you being here. Um, thought could just play it from the, Ellen suggested playing it from the computer. So since that's what we promised as a premiere to kind of show it, because there's been such a delay in getting this done and produced. I actually had to reshoot it yesterday. So we'll do what we say. Hope you're having a good evening. And I replied to your email, got your video, and loved it. Really a great video. Kind of captures perfectly the spirit of what we were trying to do or hope for. Hello, Melissa. How are you doing? Good to see you. I'm a little bit solo right now. Ellen, I was explaining to Sky, Ellen is, she's just so frustrated, and with some of the technical difficulties of this, she just needed to clear her head a bit. So we're still trying to get it uploaded to YouTube. Between doing the premiere via StreamYard to YouTube, there's some technical issues with the bit rate and then the frame size and, different issues that are kind of beyond my body of knowledge. So what we thought we'd do is just play it here off of the computer while we kind of in the background try to resolve some of the technical difficulties. And again, I apologize for being late. So without further ado, let me go ahead and throw up the video. If you have any comments as it's playing, please let me know. Actually, let me do this one more time. See if that works better. All right, the premiere of the long-awaited, much anticipated How Not to Invest. Have you or someone you know ever wondered how to start with beginning investing? We are here to help. Yeah, it is a totally common thing to struggle with beginning investing. Believe it or not, most people do. But fear not, I'm here to help you. I'm going to give you, in a few steps, a simple and effective way to invest, even if you're starting with only $50 a month. Now, I've watched several of the videos out there on YouTube, and while many were fancy and well produced, few had some good tips, most were hot garbage for beginning investors. They give you a strategy, but they don't really tell you how to do it. Or they focused on picking out individual stocks, which is utterly ridiculous for beginning investors. Now, some will listen to TV shows like Kramer for recommendations, which Kramer has a terribly impressive track record for telling people to buy the wrong things. Hell, there's even an inverse Kramer fund that does the opposite of what he says because of his track record. So hence this video and my channel. Now, my background, I worked as a portfolio manager and investment advisor for 30 years. Obviously had the opportunity to look at a ton of Did I mention that YouTube and StreamYard have not been playing well today? Let me try this and see if this is better. And I would say that's good. That's great. But how's your entire portfolio performed for the past year or 5 years? Now, all of a sudden, their face would just go blank. They really couldn't give a good answer. So I'd run the numbers for them. It's a relatively straightforward financial calculation, and at least 90% of the time, 90 or more percent of the time, the actual returns would be anywhere from 3 to 5% a year. And this at a time when the market was averaging 15% a year. So it was absolutely a horrible performance. Now, this video has 4 sections. First, I demonstrate why you should invest and talk about risk. Secondly, I'll explain why trying to pick individual stocks for a beginning investor is a bad idea. Third, I will detail a good investment strategy that time and research has shown to be outperform most other strategies. And then finally, I will show you how to begin or implement that strategy. Now, keep in mind, I am not offering you or anyone specific individualized investment advice. I'm giving information to a beginning investor with a small amount of money and giving information on a strategy which over time has shown both in practice and the academic literature to give a far better performance at lower risk for most individuals. Also, I don't profit from any of these things I tell you. Your money will not be associated with me or my firm. I receive zero compensation from any of the companies or investments that I mention. I may make a fraction of a penny from YouTube off advertising revenue, but that's it. And the good news is, if you're watching this, I'm already making that. So thank you. Now, if you're concerned about your future, your investment returns matter and matter hugely. It's not just a matter of saving some money, but it's a matter of making that money work for you. Let's say, for example, you're starting off with an investment of $100 a month and starting at age 25 or 30, going for probably until you're 65 or 70. So a 40-year period until you retire. What's the impact of higher returns on your portfolio and your investment? Well, I'll show you how to determine that and to play with it yourself. Go to www.investor.gov. This site will come up, and this site is run by the U.S. Securities and Exchange Commission. So it offers some valuable resources, financial tools and calculators. And then down here, you want to go to the compound interest calculator, savings goal calculator. Go to the compound interest calculator. We talked about starting off with $100 a month. Well, that means our initial investment we're starting with is zero. I could have initial investment, but for this example, we'll go with zero. And then I'm going to contribute $100 a month. And we talked about doing this over a 40-year period. So put 40 in for years. And my estimated interest rate. Well, let's start off and say I'm going to do this and leave the money in a bank. And I'm going to be able to earn an average of 3.5% a year. This interest rate variance range, we're going to just say the return is steady for every year and doesn't vary, just for simplicity's sake. So we'll put zero. And then the compound frequency. This is a big one. Since I'm making investments monthly and the returns generally are compounded at least monthly, we're going to switch this to monthly. Okay. So calculate, do that, and in 40 years, I'll have $104,466. Okay, not bad. Now, suppose instead of leaving it at the bank, we take this money and we invest it in an average mutual fund, which over the past 50 or 75 years has averaged from somewhere around 11 or 12%. So let's change this to 12. Go down and hit calculate again. That's the only thing that changes. If we do that, our investment went from 104,000 to 1.1 million and change. You want to know what differences in returns can do to your future? Well, that's a good example. Now, suppose we hit a great era in the market, the 60s or the 80s. Average returns in a decent mutual fund might have averaged 15%. Calculate. Well, that takes our investment up to $3.1 million. Now, if I go down and look at this graph compares the reddish line is the growth of my investment at $100 a month at that rate of compounding. The green line is just the total money that I've contributed. So by the end of 40 years, I've contributed $48,000, but my investment has grown to $3.1 million. This is what we call the miracle of compounding. And you'll notice in the initial years, if I were to draw a line, it would be relatively straight. It looks like nothing much is happening the first few years. But once I get to, year 20, year 24, that's when the magic really starts happening. The line turns almost exponential as I'm earning interest on interest. The same thing is happening the first few years, but the change is so small, it's hard to see visually. Here, it's much more obvious, but this is what we call the miracle of compounding. And this is why investors invest in the market, because everybody loves a good miracle. Now, some are concerned about risk in the market. So let's take a look at history. Here you have a graph of one of the major market indices, the S&P 500, over the past Here you have a graph of one of the major market indices, the S&P 500, from about 1920s, 25 on up through 2023. And you'll notice again, the market is growing here, but the changes are too small to be noticed or seen on the graph. But as it grows, that kind of miracle of compounding, and you have some great years. You have a couple of down periods, particularly with the dot-com bubble, 9/11, and then the subprime crisis. Since then, since 2009, the market has done really, really well, even though we've had, a little bump here. Now, the idea or understanding I want you to take away from this is that it's hard to find a 3-year, 5-year, 10-year period where you didn't make money. If I look for, say, a 10-year period, there's really only one that's noticeable. Well, two. Well, the Great Depression is buried in here. And then two, the dot-com bubble and the 9/11 and the subprime crisis. If I bought here at this peak, the very peak, it took me more than 10 years to recover my money. But if I had been investing all along, I would buy a lot of this as the market was falling. I'd buy more as it was rising, and I would recover shortly. That's the advantage of investing monthly and regularly. You smooth out some of these bumps because when the market falls, you buy more shares. When the market's higher, your same amount of money buys fewer shares. So it's a technique called dollar cost averaging, and it lowers the cost of your investment, which increases your return. So even when the market is falling, and especially when the market is falling, that's a good time to invest. Also, from this graph, we can take away the understanding that there is short-term risk, but that pales. My encouragement to you is to understand that that risk pales when compared to the very real risk of not being able to afford to live in the future, the inflation risk or purchasing power risk. Now, we've had a pretty good bout of inflation, so I think people are much more attuned to that risk than they used to be. But remember, the initial investment at 3.5%, you had $104,000. Well, 40 years from now, how much do you think that would buy compared to a million or 1.5 million? That's purchasing power risk. Every year there's inflation, which reduces the amount you can buy with a dollar. So if your money, the return on your money, isn't growing faster than inflation, you're guaranteeing yourself a lower lifestyle in the future, a worse future than present, a poorer future than now. You always have risk. You always have risk in anything you do. The real key is, are you aware of it? And do you manage it? Or are you oblivious to it? And will you be subject to the pain and confusion it brings? There is a clear choice. Now, with the markets, you have to have realistic expectations. It will fluctuate. And by fluctuate, I mean it'll drop. It'll drop on occasion. Corrections, what we call corrections of 10%, a 10% drop in the market, happen every few years. They're generally short-lived and modestly predictable. A correction of 20%, a correction is just a fancy term for losing a lot of money suddenly. A 20% drop will occur every 7 or 8 years. So if it hasn't happened in a while, don't be surprised if it does. It's due. Just keep in mind the performance I mentioned to you earlier, the average of the stock market includes these periods. Now, also keep in mind that investing is only easy when you look back. Going forward is always a challenge. Main point is, if you do it and stick with it for years, you'll be extremely, extremely glad you did in the future. Now, your investments and investment amounts matter. So if you've decided to invest some amount, how is the best way to go about it? I obviously can't recommend buying individual stocks. Picking out a decent stock isn't difficult because most stocks will rise with the market when the market goes up. But the difficulty is knowing when to sell it. Most beginning investors also don't have the time or the expertise to try to find, follow, and constantly evaluate individual stocks or companies in their portfolio, know what to buy, when to sell, and what to reinvest in. There is a better way. You hire a professional manager, and there is an easy and cost-effective way to do this. You do this by investing in a mutual fund. So what's a mutual fund? A mutual fund is just a portfolio comprised of investors who pool all their money together and then hire a manager, a full-time manager. Manager makes all the investment decisions. There are probably right now about 18,000 different mutual funds out there with all sorts of different investment strategies, philosophies, goals, sectors, investing in almost every area of the market that you can imagine: stocks, bonds, money markets, whatever. Now, for a beginner, with limited funds, I'm going to show you how to do it. I, I assume you've got $50 or $100 a month to start off with, and perhaps you can invest $50 a month going forward. How do you do it? Well, there are a number of mutual fund families that you can work with. Keep in mind, I have no advisory relationship with any of these listed. I receive zero from your relationship with any of them. They are just used here for convenience and for an example. Now, several well-known families are like Fidelity, Vanguard, Victory. I'll focus on Fidelity and Victory because they generally have smaller minimum investment requirements for the initial investment. Vanguard is typically around $3,000 to open an account or a fund. If you have that, obviously you have a lot more options and great, but we're kind of focusing on the small beginning investor. Now, to start, you simply go to Google and search for Fidelity or Victor. Here is Victory's splash page. Good family, some good funds. But I'm going to start off with Fidelity. All I have to do is Google Fidelity and click on this link, open an account. That will open up this page in Fidelity, asking me what kind of account I want to open up. I don't want to open up an IRA yet, though I may want to shortly. But I want this link, brokerage account, investing and trading. So I click on that, open a brokerage account. Are you already a Fidelity customer? I'm going to select no, and then next. Once I do that, I get this page, and this is about as complex as it gets. Name, social security number, date of birth, citizen mobile number, email, my address. Now, if I click on next, it's going to give me the option of entering in my bank account. For example, my checking account. I'll need the bank routing number and the checking account number. You can get them from the bottom of your check, or if you have an app, you can probably pull them off there, or you can call your banker and find it out easily. What that does is that electronically connects your Fidelity account to your checking account and allows you to, using your app or over the phone, to move money between them effortlessly and freely. It may take a couple of days to clear. If you need the money really quick, you can do what's called a wire, and there's a, I don't know, $15, $20 fee associated with that, but a small fee. So you can always access your money. In addition, you can make regular investments. You can set this up to where it will withdraw the $50 a month automatically from your checking account on any day of the month that you desire. So it simplifies and automates the investment process. So once you put your money in a Fidelity account from your checking, from there you can move it into stock, bond, money market accounts, or back to your checking. You can search on Fidelity for the available choices. Now, here's a search I did earlier, and this is some of the criteria that I chose. Morningstar is a rating group, and they'll rate mutual funds from 1 to 5 stars, with 5 being the highest. And understand, this is not a perfect rating system, but it's just information. So I chose funds that are either 4 or 5 star rated. Minimum investment, obviously I'm looking for funds I can purchase with $0 to $100 and no transaction fee. Brings up 100 different funds, and then it lists them for me here. When I'm looking at funds, which one do I choose out of 100 funds? Well, some of them invest in specific areas like energy or natural resources. Here's select semiconductors. Technology has been a pretty hot area. So how do I decide? Well, what I recommend or suggest is that you look primarily not at the 1 year record, because any fund can have a good 1 year period. What you want is something that performs relatively consistently, 3 year, 5 year, maybe even 10 year record. So when I look at this, I might be interested in AI. I think AI has a bright future. So I select semiconductors and I look year to date, 72%. Well, yeah, that sounds good. But, more interested really in the 3 year at 20%, 5 year, 29%. So I'm thinking, and particularly if I think that's got a bright future ahead, not just the past performance, but a bright future ahead, I can tell this fund is a relatively well managed fund in that sector. Maybe I like energy. Always going to be a demand for energy. So far this year, 1%. But if you look at it for 3 years or 5 years, different, better long term track record. I can go on down and look at, here's brokerage and investment management. Always going to make money. 1 year at 10%, 3 year 12.8, 5 year at 14.83. If I'm interested in sustainability, got a fund for that. A lot of people generally aren't as sure of the sectors. And so they generally prefer what's called an index fund. A lot of, advisors will recommend an index fund, S&P 500, which is a common recommendation. This one over 3 years is averaged just under 10%. For 5 years, right at 12%. If you want big, large international corporations, you've got that. So you can go through this list and evaluate the areas or industries, healthcare, hardware tech, chemicals. You can choose the industry or sector that you think has a bright future, or you can just stick with an index like the S&P 500 or the Russell 1000. Tons of funds, tons of choices. Now, I'm using Fidelity here, but it's just as easy to use Victory or some other fund family if you have a preference. The main problem is finding one that allows you to open an account for less than $100. Fidelity, you can open an account with $0. So the more money you have, obviously, the more options you have. But Fidelity has a ton of choices for the small investor. The other thing for you to consider, are you truly investing this money for your retirement? Now, you want to keep some money for emergencies, rainy days, but long term, are you investing for your retirement? Can you take a portion of this money and dedicate it solely to your retirement? If so, then there's some advantages tax-wise that the IRS offers if you invest in what is known as an IRA, individual retirement account. There are basically two types. There's a traditional IRA and a Roth IRA. Now, to set it up, all you have to do is just call Fidelity and talk to a rep, and they'll basically tag it. You use the same investments. It's just basically a label is put on it and a notice sent to the IRS that this is now a retirement account. Doing that in a traditional IRA, the difference between a traditional and a Roth basically is tax me now, don't tax me later, or don't tax me now, tax me later. So in a traditional, you make the investment into an IRA. Well, the money you put in this year up to, I'm going to say 6,000 or 7,000, is deductible from your taxes. 40 years from now, you've got your money, you start retirement, you start drawing money out of that IRA, you pay taxes on it, just like salary. The Roth IRA is just the opposite. You put the money in, you can't deduct it this year, but 40 years from now, when you start retiring, it comes out tax-free. So particularly if you're in a low tax bracket now and you think taxes will be higher when you retire, you'll also be on a fixed income when you retire with little flexibility in increasing your income. So not having to pay 30% of it in taxes can be a kind of a nice little trick. So the Roth may be more attractive to you for retirement options. So if you've got further questions, we cover some of this in more detail on the channel. But I hope that gives you a little bit of background, at least enough to where you start asking more questions. Now, so bottom line, screw buying individual stocks. You can do better, far better. Now, if this video has been helpful to you, then please give us a like, give us a follow, share it with friends who may need some straightforward advice how to improve their future and manage the financial markets and world. We try to come up with more information that will help you make better decisions. So appreciate you watching. And if you've got any questions, feel free to email me, moffatonmoney@gmail.com, or on Twitter, you can DM me, moffatonmoney. Thank you for watching. Peace out. Well, there you go. Not terribly fancy, but relatively straightforward and direct. Hope it made sense for those who, are trying to start investing. Hope that it provides them a suitable background and information, gives them enough confidence to play and start taking some steps in that direction. 1, 2, 3, 4. Hope you have a good night. Appreciate you joining us tonight. And if you have any comments, and seriously, constructive criticisms, would love to hear them. It's I watch some of the others, and they've got a professional media team doing it. Obviously, don't have that luxury. Obviously, how do I want to say this? Don't know how I want to say this, so I won't say it. But the idea is I've watched a lot of the other videos, and they just don't have suitable information for most people. So, tried to lay out in a relatively organized and easy to understand manner and show the basic steps, necessary to get it started with some idea. Couple questions. Melissa, been told you can't be self-employed and have a Roth. No, you can. I'm trying to remember. There is, what is it? Now my keyboard's dying on me. How cool is that? There is a restriction. I'll have to look into it to get you a more detailed idea as far as what the restriction was. It's kind of rare, but for just a regular self-employed, yes, you can have a Roth, you can have a traditional IRA, either one. There are certain limitations if you're maxing out your contributions on like your 401k, if you have a corporate 401k and still doing a IRA, either traditional or Roth. And that's what I'm a little foggy on, is exactly what those amounts and specific limitations are. But in general, if you're not maxing out your contributions anywhere else and you have the income on your tax return from your private business, you can contribute the Roth up to the maximum amount of your income. So, there's some borderline little restrictions there, but as far as not being able to do a Roth if you're self-employed, that's not the case. Thank you, Sky. I appreciate it very much. Still got a couple bugs to clean out there. They don't have the down home to earth approach. If I kind of asked myself, before I did this, because I kind of knew how it would end up. And I like talking to people. I admit I am not as at ease talking to a computer. Even having some of the questions that I can respond to helps me. I'm just not the best at sitting by myself and carrying on a conversation. So, but when I was thinking about doing this, I did go out and look at the other videos, and I thought there's really not much out here that helps somebody significantly with, a small investor to start investing. A lot of them did focus on how to buy individual stocks. And like I say, I think that's a horrible idea for a small initial beginning investor. I think it's a pretty bad idea for somebody that's not in the market full time. There's how many tens of thousands of different companies and markets and areas out there. Are you able to track them all and, analyze them all with whatever criteria you want to use and determine which ones are good buying opportunities? What do you have in your portfolio that you need to sell? These are extremely exhausting and time-consuming decisions that 99.9% of individuals don't have the time, because they're spending their time with their family or gainfully employed somewhere else. They just don't have the time to do that amount of work or study. They don't have the resources, the data available necessarily. Not even sure where to get the data from. So for most individuals, regardless of their situation, I recommend mutual funds. Now, some like myself, I would have most of my funds in mutual funds. And I make decisions based on the large economy, whether I see things overall getting better or getting worse. If I see a sector like AI or computers that's really hot, I'll pour extra in there. If I get concerned, I'll pull some, I'll reduce my exposure, pull some cash out like I have done. But I have a little play account. And, I may do some unusual or weird little things in there, but regardless of what happens in that play account, I'm not going to miss lunch. It's just a play account. So, once you get some money put aside, if you want to start a play account later on, great. But for most individuals in most situations, whether it's personal savings, personal investment, IRAs, 401ks, corporate plans, other corporate plans, SEPs, I would recommend mutual funds. It's just easier to manage. It's easier to gauge their performance. It's easier to track. And you've got other people who are in the market full time with a full staff of analysts who have a determined philosophy, who don't get emotionally involved in making the decisions, which is a big key. A lot of people have a hard time selling stocks where they have a loss position in it. And if you do investing, you're going to have some not so good days. It's just going to happen. Happens to everybody. Anybody that says it doesn't is by the name of Bernie Madoff. Anyway, you get the idea. So, I practice what I preach. I think it's a better way to invest. I think it's more efficient. I think studies show the returns generally will be higher than individuals managing their own. And so that's what I do. And that's what I recommend. So thank you, 1, 2, 3, 4. Appreciate the encouragement as well. Anybody else have any questions, comments? Again, if you have something that didn't make sense, some constructive criticism, please, let me know. We really do this channel for y'all in order to share information. That's what we enjoy, and that's kind of the purpose behind it. So if something is not being communicated clearly, if something doesn't make sense, let me know. And every suggestion is recommended, is appreciated. Talking is hard. The only thing that probably wouldn't be appreciated is if somebody recommended my editor get a new face for the show. There's a little difficulty in that particularly. So, but we appreciate y'all watching and appreciate anything that you'd like to see done different. And I'm sorry for the damn technical difficulties. StreamYard even won't let me comment. So I have to switch between StreamYard to manage the broadcast and then go to YouTube to post a comment. Green Bean's barking at me. He ought to know my voice by now. I mean, I feel like we're good buds by now. So he's a little biased. I'm going to go with he's a little biased. One, two, three, four. Can you address situations like the GameStop bubble? Yes, I can. GameStop started because of some activity on Reddit. The stock was $6 and started going up to 12, because there was a group on Reddit that started buying it. And there wasn't a whole lot of trade going on. So a little uptick in the trading caused the price to rise. Well, several things happened at this point. One, the price started rising. So people got more excited on Reddit, started spreading the word. Price rose some more. By now, computers, algorithms are seeing the rapid increase in interest in this stock. So computers start hitting the stock, start buying the stock. The race is on after that. Stock goes, actually, if I remember correctly, the stock broke 400 for just a second. Didn't even last long. Doesn't even show up on some charts because of the way they collect data. They only get prices by the minute or whatever, but it got up there. And then it started to come back down. Well, the problem with buying a momentum stock like that is, and by momentum stock, I mean a stock that has so much energy and attention and focus on it. It has a lot of momentum and it carries it higher and higher. The problem oftentimes with buying something like that is there's an awful lot of people that bought it at 250, 300, 350, 380, whatever. And the stock price dropped so fast that there's a lot of people still holding it that bought it at 300. So oftentimes by the time you see or get information that something is moving like that, you're too late. And that is a big risk, because then you have a exceedingly abnormal high purchase price. And the stock may never get to that again. I remember in the .com bubble, you had stocks like AOL. Y'all remember the AOL modem, the tone and all? I'll play that sometimes for my class, and nobody has an idea what it is. But you just have to log on through the modem. It was painfully slow. AOL was, would trade at $5, $10 a share. Well, the .com bubble hit. AOL went up over $200. Same company. Well, the .com bubble bust, and that $200 crashed back down to $3, $4, $5. And it took people 15, 20 years to recover who held on to that, who didn't take the loss. So, when you see things like that, you think, damn, I wish I'd, gotten in on it. Bitcoin now is $44,000. Ethereum is, what is it, 24? I started buying those at around 15. And trust me, I feel really stupid because I didn't buy more. Didn't sell all I had, buy more, buy it regularly, whatever, regularly enough. But you have to get to a point where you realize there's no such thing as a bad gain. And if you invest, you will have losses. But what you want to be most concerned about is controlling your downside, limiting your losses. Losses can, remember, we talked about volatility in the market, how stocks rise slowly, but then will crash quickly. Prices will fall quickly. Panic sets in. People start dumping. Computers start dumping. Everything's hitting all at once. Prices crash rapidly. So for the average individual investor in individual stocks, you don't have much opportunity or ability to make it to your computer or your phone, log on in time, and sell without taking a hugely significant loss. By the time you're able to sell, it may have reached a point where you don't want to sell because maybe it'll rebound a little bit over the next, week or month. So again, that's a problem with individual stocks. It's so subject, particularly now with computer algorithmic trading, you never really know what the computers are going to do. I mean, if I were king, I would pretty much get rid of a lot of the algorithmic trading. A lot of it's what I refer to as foreknowledge, trading on foreknowledge, which if a human was doing it, would be illegal. Computers get away with it. So they do have a modest advantage in that regard. Practical reality of this world. So that's why things like the GameStop bubble happen and why they are an extremely, what I will call a dangerous opportunity. Now, when, it was $10, I don't think anybody knew it would break 100 or go to 400. It was, this same group has tried it on some other stocks without any success. And people have tried this for a while. Just GameStop was like a perfect storm, a confluence of perfect events hit all at once. And, it was a great show. So that's my brief take on GameStop. If you want something, more detailed, let me know. Or if you just want a whole show on bubble stocks, that's something you could do as well. But I hope that helps. Sky Ricky, you're very welcome. And, Ellen will be back. She just was worn out. She just put a lot of she puts a lot of energy into things. She cares about things very deeply. And she feels things very deeply. So, but she'll be all right. She'll be with us, tomorrow night when we have the Christmas show. Also, a couple of you need to get your videos into us or comments. Just a brief video telling us, why, what you love most about Christmas, the traditions, what's your best memory, best thing to happen to you on Christmas, whatever. So we'd love to hear from you. We've got a couple videos in, and we could love to have some more. Anybody else have any questions or comments? If not, I'm going to say that I've got another one. Is that what is meant by a pump and dump? Pump and dump. When I think of a pump and dump, I think of actually more of a scam. To me, AMC was kind of a fluke event. I don't think the people starting it, meant to defraud anybody. I think they were just, now the SEC might take a little different view. They might say they were trying to manipulate the market by publicizing this so much and encouraging people to buy it to screw over the hedge funds, because the hedge funds had big shorts on AMC. A short means that you are selling it at the current price. You don't own the stock, but you sell it, you borrow it, and sell that stock at the current price, expecting it to drop where you can buy it at a lower price. So you're still, buy low, sell high. You're still doing that. You're just doing it in the reverse order. So there were some people who were kind of mad at hedge funds and felt like hedge funds were screwing the little guy. And so they thought, hey, this would be a good opportunity to screw the hedge funds. And so it just kind of took off. Price started rising. Well, when the price rises and you're short that stock, you're losing money. Just like if you own a stock and the price falls. If you short that stock, you borrowed it, you sold it at that price. So you have to buy it sometime in the future. And you want the price to fall so you can buy it lower. Well, if the price is rising, your loss is accumulating. And particularly if it's rising really high, that's one thing that fueled the sharp increase was all of these hedge fund shorts started losing big bucks. And so they had to jump in and start buying a bunch of shares to cover their shorts because they were losing their shirt. Like I say, it was just kind of a perfect storm of events. To me, that is subtly, maybe technically different than what I would call a pump and dump. A pump and dump is normally run by a boiler room. Have y'all seen the movie Wolf on Wall Street? If you have, it shows what's his name? Leonardo DiCaprio. I can't think of his name as a character, but it's a kind of based on real life. He's a real guy. Jordan something. Anyway, Jordan started investments in a boiler room. And if you'll remember in the movie Wolf on Wall Street, first job, he went in to basically a strip mall. And there was this little room that had a bunch of folding tables, people sitting at it with a phone and some paper. And that was it. And they were just literally smiling and dialing. They would, punch in some random number that they got from a service and just call and start pitching this unknown Monpa stock. It's a stock that's technically on the pink sheets. It's not publicly traded. You can't find the price online or couldn't. And so they would sell, these stocks sell for fractions of a penny. The smallest price a stock can go is 0.0001. So you've got tenths, hundredths, thousandths, 10,000ths of a penny. So $100 can buy you 1,000,000 shares. And 1,000,000 shares, if that stock moves anywhere off 1/10,000th of a penny, you've doubled your money. If, for example, that stock ever makes it to a penny, well, you've got $10,000. If it makes it to a dime, you've got $100,000 for a $100 investment. If it makes it to $1, obviously you've got $1,000,000. So a lot of people get a little excited and lost with this quote unquote potential. The flip side is most people selling you these stocks, these penny stocks, actually have already bought them. And if they can get enough people to buy them, the price moves some. Maybe it'll go to 1/10 of a penny. And then they dump their shares, they sell their shares, and the price collapses back down, never to move again. So that's what a pump and dump is. You've got a shady operation, 5, 10 guys working the phones, trying to sell stock to little trusting investors who may buy $1,000 worth, maybe $5,000 or $10,000 worth. First of all, the commission they make on that is around 60%. They'll sell you a stock that's trading at 1/10,000th of a penny for 1/10 of a penny, maybe even a penny. because they can add whatever markup to it they want. You can't find the price online. Well, and then this volume that they create drives up the actual price of the stock. They dump their shares and make additional money. So that's a pump and dump. Somebody's pumping the price up and then they dump their shares. That is technically a felony, but I can't say that the SEC is the most aggressive in enforcing pink sheet stock violations. They kind of look at the pink sheets as the wild, wild west. And if somebody is, getting involved in that, they kind of deserve what they get. I think that's wrong because this is where a lot of innocent, unsophisticated investors get creamed. And the SEC is basically saying, screw you to these people. But again, practical reality. I can't change some of those things. You're very welcome. I appreciate the questions. Anybody else? We live in times where information is widely available, but is very, very shallow. It's hard to go into a lot of depth. People don't have the time, they don't have the attention span, they don't have the resources. There's so many other interesting things going on. A lot of the people who maybe would be more interested in more detail or depth have families, kids, working. There's just a lot of demands on people's time, both of necessity, of want, just of availability of entertainment and other options. So it's good, I believe, to, be able to touch on some of these things, even though it's not great in depth. I think that you having a better understanding of what actually goes on will ultimately help you make better decisions. So I say that on occasion, but that really is the goal. Try to help you become a better investor, make better decisions for you and your family. Anybody else? Any other questions? Okay, I've taken the actual video and turned it private. We'll, pull it and try to correct a couple of the little errors and omissions, and then reload it back up shortly. So it should, in its final form, be up shortly. I will get with my editor and we'll get some of that cleaned up. Y'all, thank you very much. Melissa, you're just sweet. I do appreciate it. Y'all are very kind, very gracious. And, on behalf of Ellen, and I honestly say we do love you. She should, like I say, join us tomorrow. So if y'all have anything else, any other questions, comments, please send them in, email me, or catch me on Twitter. If some of this helped, like, subscribe, recommend it to your friends, family, have them mention us in their will. Love y'all. Y'all go have a good night. Enjoy your families, and blessings to you all. Thank you.